What's up, YouTube? So the stock market is finally having its metamorphosis. It is starting to change and move from a trader's market that has been trading on free money, on cash and stimulus, to a thought-provoking, thought-processing economic market. We see a lot of volatility in the market that's starting to come back and is starting to be placed on the news, not just on the headlines of free money coming out. I'm excited to see where the market is going to go, but unfortunately, I don't think it's going to go up. Stay tuned. We're going to talk about that next. Hello, everybody. My name is Paul Zachary Shelton Jr., and I'm the Chief Investment Officer of Warwick Advisors. We are a wealth management and investment management firm located in Orlando, Florida, with clients all across the United States. If this is your first time coming to this channel, I ask that you please ring the bell, like this video, share this video. It's my goal to increase the financial literacy of our globe. So let's jump right into it today. So as of today, the market, or as of this week, I should say, the market seems like it has an appetite to trade based on fundamental information, as opposed to just based on potential stimulus and potential money and more liquidity coming into the market. We've seen this over this since Monday, really over the last 5 trading sessions. There's been market volatility, and the Dow has been down 4 out of the last 5 days. And it seems like this volatility is going to start to increase. I'm going to show you that on some charts coming up next. One thing that I did notice in today's trading session and over this past week is that crude oil has started to rise again. This is something that I've been talking about when I've been mentioning the possibility of inflation coming back into our economy. It is very possible that we will see high inflation, and it won't be in the too far future that we will see that. And if we see that inflation, what will happen to our economy? So let's go ahead and jump right into everything today and see how the market behaved today in trading. So the stock market initially opened up down today with the Dow falling a little over 100 points to start the day. As of midday, it did pull back a little bit in the middle of the day and it's down only about 60 points. But it is showing a lot of the same signs as it showed yesterday and all throughout this week. At its lows, the market was down a little bit over 230 points today on the Dow and down about 20 points on the S&P 500. So that's about 1% and 75 basis points respectively. We're continuing to see more volatility in this market, and it's continuing to increase more and more, and it's continuing to trade on the fundamental news that is coming out, not just on the economic stimulus. And this is something that is very important for the market to do on a regular basis. If you look at this chart here, this is the chart of the S&P 500 over the last year. You see the dip down from the highs there in late February down to the bottoms that we saw in March. And you see kind of that V-shaped looking recovery, but it's starting to bend off towards the right end of that chart. And as you can see where it's starting to bend off, our relative strength index has actually started to, modify and shift down a little bit, but it's not bending as much as you would expect if we were, thinking that there was going to be a significant breakout in the market. It's really just kind of flatlining and modifying its way down as the market is moving down at a quicker pace than it is right now. So one of the things that really led a lot of the volatility and turbulence in the market today was the retail sales numbers. And as you can see here, the retail sales plunged about 16% in the month of April. And this was far worse than anticipated. The analysts on Wall Street were expecting a drop of somewhere around 12.3%, but we far exceeded that. And I'm going to show you a chart coming up next where it's going to show what were some of those companies and some of those areas inside of retail sales that caused this precipitous drop in there. But as you can see here, one of the biggest things noted in the key points below was that restaurants lagged badly. So did service stations. I remember back in the Great Recession, we had this very similar things happen. Not as bad though, because we didn't have a quarantine situation. So you didn't have the restaurants that completely lost all productivity all at one time. but it slowly dissipated over time. And the same with the gas stations back in the Great Recession. Those gas stations, when prices went really high and people weren't driving and people couldn't get out on the roads and move around like they typically did, we saw a significant amount of gas stations that were not able to sell those other convenience services or other convenience items that they have, and it caused a lot of them to go out of business. It's very possible that we may see something similar happen right now, especially, and it's going to be really bad, especially because gas prices are still very low at this point. For now, they are very low. But as gas prices continue to rise following crude oil, it's important to keep an eye on that. I know a lot of people don't like to really focus on core inflation because it has food and energy in it, and those are such volatile parts of inflation. But it is very, very important that you do not ignore core inflation, because those food and energy prices, when they do spike and they do have a lot of volatility, it acts as a de facto tax on the American consumer. And it reduces the amount of consumer discretionary spending that Americans have. This next chart here talks about the drop in retail sales, and it compares it, like I did before, back to the Great Recession. Now you see inside that yellow bubble there, that was the height of the drop in retail sales. Now that was a loss of just under 5%, and that was in the middle, towards the latter part, I would say about 60% into the Great Recession at that time frame. It wasn't at the beginning, it was towards the end and at a point where we were about to recover. If you look at where we are right now as of April 2020 with a drop of 16.4%, that is astronomical to start a recession with. Look at it compared to 2000, I would say roughly that's about 2009-ish, heading towards 2010 in that chart there. I don't have the dates below, to compare it to where we are now. Just under 5% to just over 16% to start the recession. We were starting to recover and come out of the Great Recession when we plateaued out at 5% or just under 5%. So it leads me to believe the worst has not yet been seen in our economy. With 36 million people unemployed and a ton of economic stimulus out there trying to combat it, but really may not be able to handle the amount of unemployment that we have in this economy, it's very, very possible that these retail sales numbers can drop and drag down, double what this is right now. We could see a 30% drop in retail sales, especially when you combat that with the retail apocalypse. Is something that I've been speaking about for the last year and change that's been going on. And we can talk about that right now. With this next chart, you see retail store sales by category. This is the percentage change from March to April. All of the subsectors under the retail stores saw a negative except for one subsector, and that was the non-store retailers. Those are the places that do not have the brick and mortar. Those are the stores, or the retailers, I should say, that we all order from our cell phones, from our tablets, from our computers. Those are all of those cyber stores that deliver goods to us, to our front doors. That has been the appetite and that has been the preference of the U.S. consumer over the last several years. We've seen far less and less and less brick and mortar stores. So if you look down this list, you see all of the subsectors under there, from building materials, motor vehicle and parts, all the way down to clothing and accessories, which saw the biggest drop off in sales of nearly 80%. That's all of our malls, all of our outlet centers, all those shopping areas where people are just not shopping. And one of the reasons is because people couldn't get to the stores. They couldn't quarantine. They were in quarantine, so they couldn't go out and shop at a lot of these places. People were not buying furniture, sporting goods, food services, and all those different things, at least not from the brick and mortar stores. All of this transitioned to those online outlets, and it kind of gives you an idea of why, some of those companies like Amazon and those different places have done well over this investment period that we just recently seen. As I look through this chart, I'm looking at all these different subsectors, and unfortunately, I don't believe that all of these subsectors are going to come roaring back. I mean, you have some of the areas in there like the gas stations, healthcare and personal services. There's a lot of CVS, Walgreens, Kroger, a lot of those grocery stores. People, they're still open, but a lot of people, because of the quarantine, did not go out and shop in those stores. So it's very possible that once the quarantine's open and once the country fully reopens, that we will be back in those stores, and that the retail sales will pick back up in those stores. But I do believe that since everyone has been home for the better half of 2 months, that we all have grown a great fondness for the ability to order all the things that we need through our fingertips and have it delivered to us. So this is a major shift that we're seeing in consumer preference. This is a major shift that we're going to see, and I think it's going to continue to play out for some time now. Some of the other things that caused volatility in the market today was the tension between the U.S. and China. And as I read that headline, I was like, are you serious? We will never get over all of this tension between the United States and China. And now it's been zeroed down directly on Huawei. There is the global chip maker Huawei, that is the Taiwanese company that provides a lot of the software and a lot of chips and the technology that supports Apple phones, a lot of Apple technology, a lot of other computer chips and things that we use on a daily basis in this country and all around the globe. So it looks like it's just more trouble, more frustration, more things that are going on. But one of the things that was noted, and you can read it there, the key points there, says the U.S. Commerce Department said it was amending an export rule to strategically target Huawei's acquisition of semiconductors that are the direct product of certain U.S. software and technology. So the U.S. Commerce Department is going out of its way to amend a rule that's in place to specifically and strategically target one company. That's a lot of resources and a lot of energy to put into one company. And as such, as this being the case in part of the headlines this morning, there was some additional volatility that we saw in Apple today. And as you can see during the market, it was trading lower during the middle of the day today, as well as the whole technology sector traded lower throughout the day. One of the things that I have noticed is that since the stock market is starting to have its metamorphosis from a trading on free money market to a trading based on economic theory market, we've seen a shift in the volatility. We've seen a shift in the VIX. And as you can see from this chart in the lower right-hand corner circled in blue, the VIX dropped down to roughly about 31 or just above 30, right in that range. And that's typically a sign that shows that we're getting to a point where it is oversold and that there's a possibility of growth in the VIX. When we see growth in the VIX, we understand that there's more volatility in the market. As it is right now, the VIX is currently a little over $33, just under $34, which isn't extremely high considering, where it came from at roughly about $82, $83 at the height of the market when we saw the most volatility back in the middle of March, in the April timeframe. So it is much, much better right now, but it looks like we have bottomed out on the VIX and we're going to start to rise a little bit from here. So please leave your comments below. Let me know what you think about the market and how do you feel about the market and the direction that we're going in right now. I think the metamorphosis that has taken place and that we've seen with the rigid back and forth and the tug of war between positive and negative on the stock market this past week is very, very good. It's a very, very positive thing that the market is positioning itself to trade back based on fundamentals as opposed to trading purely on the notion of free money and future inflation, essentially. The stock market where it is right now and where we are with 36 million, almost 37 million people unemployed, a huge plunge in retail sales numbers, and all the data that we're seeing right now does not warrant the prices that we are seeing in the market. We did have a small jump in consumer sentiment, but that was only based on the financial stimulus and economic stimulus that has been poured into the economy. That economic stimulus will not last forever. We can't live off of it forever. If we did, we will become the Roman Empire, and we know what happened there. It's no longer there. So the economic stimulus will pass. The market will have to stand on its own legs. The economy will have to stand on its own legs. Leave your comments below. Let me know what you think about it. Let me know where we're going in this trading economy right now. And if you're interested in the free financial planning cheat sheet and a copy of the investment letter that I sent out to all of my clients last week, explaining everything that I see that's going on in the market, please leave a comment below and I'll send that over to you directly. Lastly, before you leave my channel, please hit the subscribe button. Please like this video. Please share this video. Help me increase the financial literacy of our globe. Thank you so much and have a great day.